Hello, everyone, and welcome to yet another episode of Punch Card Investing. I think we're on episode 28. That's a lot of episodes, and it's one of our favorites that we like to do every quarter, which is our best ideas. Doesn't necessarily mean good ideas, because the best of the worst is still the best, right? Because we as value investors are very picky, and that makes it kind of difficult sometimes when we're forced to say, "Hey, what's your best idea right now?" Well, it's this, but I might not be buying it now. Maybe you are buying it. So just take all this with a grain of salt, of course. But we're going to go over our 5 best ideas, or our best idea that each of us has. So you get 5 different ideas, hopefully. And we're going to go from there. And if you guys have any questions about whether it be these holdings, or if you have some other idea that you think we should take a look at, or some other concept totally unrelated to our best ideas, definitely let us know in the chat. Hit the like button, hit the subscribe button. I don't think I'm forgetting anything else, am I? We have a very special item for this episode, though, that you're definitely going to want to stay tuned for. I guess I'll kick it to Tom to explain it, but we're revealing the punch card portfolio, which will be directly linked to our best ideas, because these are the ideas we're going to be discussing. But Tom, why don't you explain to our lovely audience what we have in store for the punch card portfolio?
Yep, I will do my best. If I cut out or anything, just jump in, because my internet's very bad today, so apologies for that. So we've been running the Best Ideas series on the channel for a little while, and Jack put up a poll last week to kind of gauge interest around whether we turn our best ideas into a punch card portfolio that we kind of track over time. So I think we had a couple of people that thought it was a bad idea, but the overwhelming majority thought it was a great idea. So we've gone ahead and done it. We've got kind of some basic rules. I think it may we'll kind of just see how it goes with the current rules, and it may develop and change a little bit over time. We'll kind of have to see. But the basic structure initially is that we've got a hypothetical. We've just picked a number out of thin air, so we've gone from hypothetical $1 million portfolio, 5 stocks, so 1 per person. We all contribute an idea as an initial kind of position, and that's kind of a portfolio that we'll just track over time. And on these Best Ideas series, or whenever we have a stock that's kind of interesting that we talk about, if at least 3 of us agree that deserves a spot in the portfolio, we're then going to basically turn it over to the subscribers, to you guys, to vote on which stock needs to disappear to kind of make room for that new position.
Extreme drama.
Have I missed anything?
I think that's it, right? We're gonna we'll give you guys periodic updates, and if there's something we want to add, it'll be up to you to decide which one is out in its place. Wow. Which will be intense. Whoever's first to get out, that'll be fun. We were considering just doing it right away for this first week, just having a vote right away. But we want to give something a little bit of a runtime to get some data going and see which holdings are doing well. Granted, anything can happen in the short term, but we're definitely excited about this one. Should we mention ShareSite as well? Because we're now affiliated officially. If you guys check out the ShareSite link in the description, that's how we're going to be tracking this portfolio. If you guys, we'll show it later on in the stream if you want to take a look. If you're not already using it, because I know we have a few affiliates here who are already pitching it all the time, because it's a nice platform, and it allows you to track your portfolio in a few different ways, and gets a little bit more into the weeds than a lot of other basic brokerages might do. But we'll get to that later on. But if you want to check out ShareSite in the meantime, you get 4 months free if you use an annual membership when you use our link in the description below. And again, we'll show you later in the stream what it looks like. All right. With that said, shall we finally get into our best ideas? Does anyone want to volunteer to kick it off with the first of the 5 holdings in the punch card portfolio?
I can kick it off if you want. I beat you to it, Tom. I'm going to jump in.
Less lag.
Yeah, I'm on a big lag at the moment. Go for it.
So now I'll preface this with saying that I personally bought into this company a long time ago. So I'm up about 200 or 300% on the position. Bought it at 91 cents.
Could that be?
So I don't have to talk about it too much, because I talk about it, I feel like, almost every single episode. It's Kelly Partners Group with the ticker KPG in Australia. It's certainly my highest conviction idea, but it's probably not the valuation that I would want to pay for it. So I am putting it into the portfolio as my, I guess, highest conviction idea. But I bought it at 91 cents. It's now, last time I checked, around $3.60. We could probably, 362. There you go. So I'm up significantly on the position. And I got a huge multiple re-rate that I kind of expected to happen over probably 5 to 10 years. It just so happened that went in about 1 year. So there was a lot of upside there that I didn't expect so quickly.
Do you give us a quick synopsis on Kelly Partners Group for anyone who is new to the business?
Yeah, so it is a small cap or micro cap in Australia. The CEO is probably one of the most appealing parts of the business, Brett Kelly. He owns around 50% or just over of the shares. If you read some of his writing and the investor presentations and everything else, he kind of is a big Buffett nerd, I guess, often quoting Buffett and kind of implementing some of the same capital allocation decisions. So there's a lot to like when you're looking at just the management aspect. They did in 2017. I think they were founded in around 2006, roughly. But since listing, they've compounded their owners' earnings at 26% and had a return on equity of 30%. And the shareholder return's been about 41.6%. And again, most of that came from a multiple re-rate not long after COVID, which it went from about 8 times earnings to probably around 35 times earnings now, if I was guessing, but significantly higher nonetheless. Now it's kind of at the point where I would say it's fair valued. So most of the return we're going to see now will come just from the earnings and the dividend it pays out as well, which is pretty insignificant. It's about a 1% dividend yield, but it is an extra return. The 3 places I look for, or any stock can get a return from, is their earnings per share growth over the long time period, the multiple re-rate, and the dividend. The multiple re-rate I don't expect to go any further. Possibly if we keep seeing these high returns, we might get a little bit, but definitely not something I'm expecting. They're essentially an accounting business. So they roll up lots of small, cheap accounting firms in Australia. Most of the accounting firms in Australia are people that are reaching retirement age. So they're often willing to sell and they have to sell for a relatively cheap price. And they kind of run this roll-up strategy. So if they buy, say, 2 or 3 accounting firms, they kind of take all those accountants and put them into one to kind of improve their margins. So, and there's a few other ways they improve their margins as well. So they have about a 34% EBITDA margin compared to 17% for the rest of their accounting industry. So well above average in terms of margins. And essentially there's a huge pool of these accounting firms that they can just continue to buy for a very long time and achieve above average returns. Brett Kelly has put out over the next 5 years, he expects the business to grow at 15%. So our return should be around the 15% mark. But he's always been conservative with his estimates and has always outperformed those estimates. So I would expect it to be closer to the 20% range. But yeah, that's about it. Any questions on that one?
How did you find that one again? I know you've said before, but how did you come across that idea?
It actually come from a guy I met on, I think, a Facebook group. I met him. His name's Tristan Wayne. You can follow him on Twitter.
You mean Meta?
Yeah, I mean Meta. The name change. Yeah, and he's a really smart dude. And he ended up actually working for Kelly Partners Group after pitching me the idea. He's an accountant himself, runs a very concentrated portfolio of microcaps. I think he owns 3 positions. Doesn't run a fund or anything, just a private investor, but clearly a smart dude when I was talking to him. So he pitched the idea. I jumped in pretty early. And yeah, it's been all uphill since then.
When did you buy it, Frank?
I want to say July. 91 cents was the price I paid. So
July of last year.
2020, yeah.
Okay. Yeah, it looks like the multiple is up like 3x or something, huh?
Yeah, almost all the returns come from that in a short time period. And again, I expected that to be kind of in my estimates over 5, maybe 10 years, we get that type of re-rate, but sometimes it happens pretty quick, which is a bonus.
What would anything push you to sell, like a certain price point, if it happened in the next month or something?
From the price I paid, it'd be hard to make me sell. Like, I can afford to lose a lot in this one. So even if it got extremely overvalued, say it was trading at 50, 60 times earnings, which I don't think it's worth, I still wouldn't sell. I'd probably just hold and see what happens, just because I have faith in the long-term prospects, even if that returns a little bit lower than my 15% target, just because on average, it's going to be around that for a very long time. Probably a change in management is what would make me reconsider.
Frank, you're going for the 100 bagger, aren't you?
I hope so.
It's weird because it's already at, like, compared to where you got it at, it feels like it's already run its course, but it seems like it's just at the beginning of its kind of exponential, or maybe even if it's not exponential, long linear curve of growth. So like, you keep bringing it up because it still seems like a good opportunity, and that's obviously why you're still holding it. So definitely don't be ashamed that you keep bringing it up. And it's our first addition to the punch card portfolio, and we'll see if it's the first one out too.
Frank,
Brett Kelly's a pretty young guy, right? In like Warren and Charlie terms, he's still pretty young.
And Warren and Charlie terms, yeah. Everyone's young.
I'm guessing,
Right.
but I think he's about 45 or so. That's a guess, but he's not very old now.
Do you have a sense for like the total addressable market here? How big the market cap could grow into?
Yeah, so there's a couple of ways you can look at it. The broader accounting total addressable market in Australia is like 22 billion, I think it is, maybe.
Okay.
Say 20 billion, but their pool of kind of small and medium enterprises that they want to acquire is about 12, and their revenue is about, I want to say, 50 million. So they're a tiny portion of their total addressable market. And like I said, a lot of that is reaching retirement age. They buy these businesses for about 4 times EBITDA on average, so extremely cheap.
Awesome.
Are you looking to add to that position at all, or are you just kind of, unless you get like a huge windfall, you're not really going to add to it?
Yeah, if the multiple went down back towards the below 15, like when I was first kind of interested, then maybe I would consider it. But it makes up such a large part of my portfolio that I'm just trying to not touch it at the moment.
What about the dividends? Are you reinvesting those, or are they just going elsewhere?
I keep the dividends. It just kind of adds to my cash position over time. It's actually a monthly dividend, so they come in small amounts. So I just kind of pile them up and put on the cash pile.
You know, hold it till they compete with the big four. That would be something.
Well, they're quickly moving up to the big four in Australia anyway. So
One country at a time, one market at a time.
in their investor presentations, they always put the list of the top accounting firms in Australia. And I think by revenue, and I think they're about 21 or so at the moment. So, and they quickly move up that list each time they post it.
Yeah, still have quite a ways to go, actually. I'm actually a little
Definitely.
surprised. Which is, I guess, good in their case as they continue to gobble up market share.
Yeah, I followed Brett Kelly on Instagram, and I see it looks like they bought a business just today, or like in the last few days in Canberra.
I haven't actually seen that one, so you're telling me something
there you
new.
go. It's all action.
A question here on the debt, Frank. Does it worry you at all? Probably not if they're continually acquiring new assets, but always worth considering.
Not at all. They're really on top of their kind of how they use their debt. That's how they fund their acquisitions, is through debt. And when you're looking at the debt on the actual balance sheet, it's kind of misleading because of the structure of their company. Each firm they kind of roll up, they take a 51% stake. So a lot of that debt, although it appears on the holding company's balance sheet, is more liable to the partner owners of the accounting firm. So it appears higher than it actually is. And it's not getting higher relative to kind of their base. Like it's always at kind of the same multiple. They're actually improving that slowly over time. And again, that's how they fund their acquisitions. So no
Are you
concern.
saying that, like, using the 51% example, really they're only technically liable for 51% if it came down to it, and then they would have to go after the other partners if for some reason one of the businesses wound up?
It doesn't quite work out at that ratio overall, but yeah, it pretty much that's the rough idea.
Sure. Cool. Any other questions on Kelly Partners?
Are you going to the annual meeting? Should we have a meetup? I'll fly to Australia.
They had their annual meeting recently, and they had William Thorndike and
Wow.
Yeah.
I'm blanking someone else, another big author that presented at the annual meeting. So
Okay.
it's a good one you can watch on YouTube as well, I'm pretty sure.
He's cloning Buffett with the big annual meetings.
Yeah.
He's-
Tourist attraction for investors.
He's trying to really pump that up. The one main concern that I have about Kelly Partners, like the over promotional aspect of Brett Kelly concerns me. That's probably the main pushback I get, other than the debt. The debt always comes up, but once you kind of read through the structure of that debt, it's not a concern. But it's putting a lot of faith into the CEO, and he does come across as very promotional. I've talked to him twice now via Zoom, and both times he's clearly obsessed with what he's doing. And he does come across kind of salesy, like I don't know how to put it, but I have faith.
Charismatic, Frank.
Very,
Not
very.
salesy. I wonder if that's like. Let's actually talk about that a little bit more on like salesy CEOs or executives. How much of a problem is that? Obviously, if it's like fraud, that's not what we're getting at. But someone who's like really pitching, like it's like pitch first. Like, would you rather have like a pessimist? Like who do you want leading the ship? Well, I'm trying to get like what's like the real problem with being like a salesy, pitchy kind of CEO.
Just kind of makes your skin crawl, I would guess.
Is that it?
Yeah,
Is it,
I think
something more fundamental?
The issue is you get sort of overly optimistic about businesses, I think, really. And it's sort of, I don't think it's uncommon. Maybe this is an interesting example because Brett Kelly's the founder, but I would usually say unless they're a founder, like most of these guys, and they usually are guys like running these businesses, are quite salesy. It's just kind of, they have to be to get to those positions in big companies.
Mm-hmm.
Yeah.
And that's why, people like Monish Babrai, Guy Spear don't generally talk to management unless they're going to like India and trying to pick up whether this is a fraudulent business or something like that.
Yeah, right. That does make sense. Like, and even in like a non-corporate environment, like just a startup atmosphere, if you're trying to get money, you're going to have to be pretty salesy. You're pitching the business. That's like probably just an idea at that point, or you have a very vague sort of business structure. And you have to have some sort of sales skills. And yeah, you're not going to forget about them when the company's a lot bigger. So that does make sense.
I did kind of ask it to him in a roundabout way when I was talking to him about the investor presentations and how they're clearly directed towards like value investor type people and people that like Buffett. There's a lot of these quotes in there and stuff like that. And the way he kind of responded was that they're focused on this quality shareholder kind of framework, which comes from Lawrence Cunningham, who's actually the other person that spoke at the annual meeting. And the reason they frame their stuff that way is so they attract these long-term shareholders that are going to hold it for a long time. And yeah, that was his reasoning to why he promotes it that way, I guess.
All right. Should I move to the next one? Always good to get some KPG in.
Yeah, I can go next because I'll be fairly quick. Everyone's heard of this one. So after we stop live streaming, and we usually chat for a bit after these streams, we had a we had a heated debate about who gets to pick Alibaba as one of their 5, and somehow I won that. I don't know.
I don't think it was very heated, Tom. I think you're hyping that up a bit. It was quite civil.
Guys, we got to build up the beef.
No, I'm the only one with beef here. That's with Karan. But everyone knows that.
Yeah, Tom's
We'll
like, I've
talk
got
about
the
that
most
after this one.
subscribers. I deserve Alibaba. So we're like,
That is not what I said. Oh god, it's going downhill. Okay, yeah, I've picked Alibaba. I think most people watching will know the thesis pretty well at this point, but I guess initially it's one that came on my radar as a clone from Munger, and eventually Pabrai, and eventually like 5,000 different other value investors that we all like. So that's kind of how it first got on the radar. We've covered it on the channel, and we've all covered it on kind of our respective channels. Where I've kind of landed with it is, I think probably just the e-commerce business is worth maybe in the high $200 and ADR kind of range, and I think it's like 160 or 170 or something at the moment. And then you get like net cash, 1/3 of and financial, which is huge in its own right. And then you get a cloud business growing at 50% a year that's only just kind of reaching profitability. So that's the explain it to a 5-year-old version, and that's kind of how I like to simplify these things down once I'm done with the research. So that's my pitch.
Are you adding now? I think we've all kind of asked about this before, since it's dropped so much since it got kind of into the value circles just a few months ago. It's dropped well off of what, like when we first heard about Charlie Munger buying in over $200, 200 US. What are you buying now? Are you considering buying now? Is there a price target you have for it?
Yeah, so I'm down on the position. So in theory, that would mean that if I still like it, I should be adding. But I feel as though I've kind of maxed out the allocation I'm comfortable with at this point. So my cost, I think the highest I ever bought it was like 215, and my cost basis is almost exactly 200, maybe maybe like 201 or something. So I think I've bought it as low as about 165, 170, somewhere in there. But most of the position was added kind of around the $200 range. So that didn't pull my cost basis down a huge amount. If it were to stay low for like, I don't know, a year, 2 years, and cash kept coming in and it just kind of got diluted down in the portfolio, maybe I'd consider adding more, but I'm pretty comfortable with where it's at right now.
I think it's lower than all our cost bases right now. The price it's trading at.
I'm sure.
I'd be surprised if it wasn't. Yeah.
My position started so small. I think it's about the same for me. I think my cost is like 170.
Yeah, nice. The great thing about this exercise of starting a punch card portfolio is we can reset a cost basis in this theoretical portfolio.
That didn't help me for mine, but it definitely helps for Baba. That's for sure.
Yeah.
I think it doesn't help for Karan's either. We'll get to that.
I'm at like 200 also.
Yeah.
Which is not off a lot, but
yeah. So I don't know if you got any questions for me, but
I'm looking for any Baba questions. Normally our chat.
I think last time Alibaba isn't in the chat. It's not taking over the chat.
Yeah, that's unusual. Maybe people aren't.
I think everyone's
anymore.
just
everybody owns it already.
Yeah. There's nothing
everyone's
to add.
heard enough. They saw this. They saw this coming. So
we gotta talk about some risks. Like, what on the downside like concerns you the most, if anything? I guess because we've heard of plenty of things in the news. Does anything like particularly concern you at all with the Baba position?
Yeah, so there's kind of a couple of things. So obviously the big red flag that has always kind of been hanging over Baba that came up even before recent regulatory changes and crackdowns and so on, is this whole VIE structure. So you're buying an ADR of a VIE in the Cayman Islands as opposed to just straight up buying shares like you would in most American businesses. So I don't know. It's a bit of a tricky question to answer and a very tough risk to put like a percentage probability of that falling over in my head. But that, I guess, is something to keep in mind. there have been some changes with the Ant Financial business. I know Frank's done a fair bit of work on that, and that's going to be more capital intensive than it was before, and will probably grow slower and be less valuable as a result. But I think there's so much margin of safety kind of built in with where the price is right now, and the e-commerce business is doing really well. The cloud business is doing really well. If you focus on the actual business metrics, like we should, it looks really attractive. So, there's always risks with this, and it's also a very large and very complex business. So, it's one of those things where I think you have to kind of get a little bit comfortable with, I don't want to say incomplete information, but not knowing every minor little detail, but I think you can, I've said this before, I think you can put most of the businesses into like some key buckets and get a feel for, at least directionally, where those key parts of the business are kind of heading. So, there's risks with any investment, but I think at a certain price, you kind of get paid to take the bet.
Fair enough. I forget, Tom, William asked here, like, what are your guys' thoughts on Pinduoduo in comparison to Baba? Did you do research on Pinduoduo? Or no, you looked at JD.com fairly closely, right? Or am I mixing that up?
I looked at JD a little bit. I wonder if the Tencent Prosus guys might know a bit more about Pinduoduo than me, because I think Tencent has a reasonable ownership stake in Pinduoduo from memory, but they're like quite a fast-growing, almost like Chinese version of Groupon is how I kind of understand Pinduoduo, but
The
I haven't
products
done a
are
lot of
also
work on it.
the products are different that are offered on Pinduoduo as opposed to any of the other platforms. Yeah, it's more directly to the farms, or the products go from the farms to the consumer directly in a lot of cases.
Mm-hmm.
Yeah.
Who's up next?
Okay, I'll follow up.
Do it.
Yeah. So I'm going to be adding some crypto to the portfolio. So I'm adding some Shiba Inu, right?
Shiba Inu. Portfolio's already up 10x.
Yeah.
It's been going for a
100x.
day.
Sure, we need something, to like diversify a little bit.
Yeah, uncorrelated.
Yeah, uncorrelated.
Inflation hedge.
Right. Who was warning us? Jack Dorsey. Yeah, Jack Dorsey was warning us that hyperinflation is coming.
Hyperinflation is coming. Yeah.
So therefore, by Shiba.
Of course.
the connection. It's
A natural, yeah.
Yeah,
All right.
so the company that I'm adding is Prosus, which is basically like a proxy for Tencent at this point. But moving forward, I think 5 years out, Prosus is going to look a lot different, because I expect them to start selling off their Tencent position a lot more. I think they've sold off a little bit, like in the last few years, but I think they're going to continue to do that and then reinvest the proceeds into other investments that make sense. They've done fairly well on their investments, even apart from Tencent. So yeah, it's just all about good capital allocation. You get the margin of safety with the Tencent stake, and moving forward, hopefully the portfolio looks a lot different in the next 5-10 years.
So is
what's
this Go ahead, Tom.
What's the rough? So Prosus is, you're effectively just buying mostly Tencent, right? So what's the discount sort of to net asset value look like at the moment? And because that's got quite a bit wider over time as well, right?
So yeah, the discount, if you look at the market cap here, it's probably not correct, wherever it is. Okay. So yeah, it fluctuates quite a bit, because it was, I think, a huge discount earlier, and then it kind of covered up. And it's strange. Why is it showing 281?
A lot of the websites, including Bloomberg, have the market cap wrong for
Yeah, it's wrong.
Prosus.
Yeah. Right.
I think Google has close to the right market cap.
Google is also off. Google Finance is wrong.
I think they say about 150 or something on Google. It's closer.
It's like 110 or something, like probably around that range. But yeah, so the discount to the Tencent stake does, if you account for the tax implication, it deserves like maybe a 20% discount, but it trades at a lot more than that. So you've got like the margin of safety with the Tencent stake, and then pretty much all the other investments that they've made are not even included. So you get all those other investments for free on top of the Tencent stake.
The discount to net asset value is about 35 to 40%, I think is what the company quotes it as. And then if you take an intrinsic value for that 10-cent stake, which I would argue is about 30% discounted, then you get a much larger discount to NAV, maybe closer to 45%.
They publish their NAV on the website.
Yeah, which, yeah, again, I think is probably conservative, but you have to be bullish on Tencent to agree with that. Not everyone would think that 10-cent stake is undervalued, but at the moment I do.
Also, one other thing that they're doing, so they're engaging in share buybacks, which is pretty much the reason that got me interested in Prosus, is because the management is willing to give money back to shareholders. I find that to be a positive sign. Like they're buying back into their shares when Tencent is come down quite a bit in price, and I think that's a good capital allocation decision.
Would you consider this? You were kind of saying earlier, but is this more like a medium term? Once it catches up with the NAV, or if it ever does, then you're out, or are you really looking more for the long term here on like capital allocation?
Yeah, I'm holding this position for a while, like it's a long term. I think in the long term, like Prosus is like a bet on like Indian startup ecosystem in a way. So that's kind of also what I find quite interesting, because they have quite a few good investments in India, and I think long term that's where the focus of the company is going to be.
It's also like
But
a
right now it's
strange
like
way.
80% Tencent, right?
For now,
about that. Yeah, it's also a strange way to kind of access a lot of the tech names and like a VC type portfolio at a cheaper price, because Tencent itself has their diversified portfolio that's arguably worth close to their market cap right now. Then you have Prosus that also have their own VC portfolio, and if you exclude the Tencent stake from that, it's still one of the largest VC portfolios in Europe. So it's like this strange way to get access to these high growth companies at a low price. But again, 80% is a Tencent. So if you don't have faith that Tencent is a great business that can grow for a long time, then it's not worth even considering just because of the VC.
Mm-hmm. Have Karan or Frank, have you guys taken a look at SoftBank at all? Because as I understand it, at least that's like a similar situation where you've got a discount to net asset value, only it's like the Alibaba version, and I think listed in Japan. Is that something that's of interest or that you've looked at?
I've looked at it slightly, just more so within my Alibaba research, but the stake in Alibaba, I think, is about 40% of their portfolio, so it's not as concentrated, like it's not a direct Alibaba investment. Mm-hmm. So you have to be more comfortable with the rest of the portfolio, which I personally probably wouldn't be. Karan mentioned that he wants them to sell off Tencent. I kind of stand on the opposite stance there, where I want them to sell as little as possible of that Tencent stake, just because I have such a high conviction in the Tencent business. But yeah, that's the main difference I remember from SoftBank. And they have a very out there CEO too that, depends how you want to describe him.
Yeah, I think with SoftBank, like their capital allocation decisions, at least in my view, haven't been great.
Not lately.
Yeah, I mean, it's like you're taking a good business, selling out of Alibaba, and then you're buying into stuff like WeWork. So
that was like the biggest. It had to be one of the biggest disasters, like pre 2020, right? Like it was like leading up to the pandemic. which exacerbated the problem even worse for like co-working and WeWork and all that stuff.
WeWork is public now. Did you guys know? It went public this month.
I didn't even know that. They snuck that in, huh?
How was it done?
Yeah, I think on 21st. I have no idea.
Was
It's
it one of
called Bao X. It merged with a SPAC, as you would expect.
It was a SPAC merger, huh?
Good.
Look how SPACs have just fallen out of favor. No one hears anything except for the Trump SPAC, of course. That one's like top of the news. But all other SPACs just like faded into non-existence when it comes to news.
Well, to be fair, Chamath still puts out his monthly results and tries
he
to
does,
get
but
people excited.
that used to be top line news, though.
That's true.
Now
That's
it's buried.
true. Yeah.
And I think he's frustrated. So Prosus.
There's a lot of people wanting Meta in the portfolio, guys. Just to remind everyone, we have periodic votes, so perhaps we can squeeze Meta in at some point in the near
will
future.
do some sort of discussion on Meta probably next week, I would think. No, don't quote me. Things can always change, but we definitely, with all the news, of course, we definitely want to take a look. I know Frank, you just put out a good video on kind of their business pivot and going forward, what the growth prospects might look like. So if you guys want an overview after this episode, of course, go check out Frank's channel. So we're at 60% of the portfolio then. And anything else on Prosus? We got Baba, we've got KPG, and we've got Prosus. All three very different businesses. So
in very different parts of the world.
And the people are loving you in the chat, Karan.
Karan over buff dog anyway.
Who does better compound rate next 15 years, Karan or Berkshire? And we got a bunch of Karans in a row. No
I've just gotten
Berkshires.
lucky. It's just luck. Like so far, it's just luck.
And it also helps not working with 180 billion. You got to move.
A little bit, that helps a little bit.
Karan, you are
Ted
so
and Todd
humble.
might pull something out of the hat.
Sorry.
You're
Ted
like
and
the
Todd might
opposite.
pull something out of the hat. Yeah.
Yeah, they
We'll
bring
have
on
to see.
Karan. They bring on Karan to manage some of the
Yeah.
money.
Yeah. What if Karan is Berkshire?
Whoa.
Joins
Is
the
this a
team.
metaverse thing? I feel like I entered the metaverse.
Guys, we should have just covered Facebook today. Honestly.
Frank just got sucked in.
Maybe we should have,
Yeah.
but
He's gone.
This is priorities, Karan. This is important. We get our best ideas in and get this portfolio going.
All right. Well, I guess I should take us to the next pick here.
Do it, Brad.
Pick number 4. One everyone is familiar with, Seritage Growth Properties. Big surprise, huh?
Hey yo.
You did the deepest dive of all of us.
What's that?
You did the deepest dive of all of us when you
Yeah,
went through
well-
all the individual properties of some time ago.
Yeah, how accurate those were remains to be seen. But yeah, so for anyone who doesn't know, the quick on Seritage is in 2015, Sears spun out a bunch of their real estate holdings into a company called Seritage Growth Properties. When I dug into, I think it was like 180 some companies in the portfolio, I came up with kind of a liquidation value for Seritage of somewhere around $4 billion. And, so you take off the $1.6 billion in debt owed to Berkshire Hathaway, and you've got about $2.4 billion to equity, which the current market cap is somewhere around 800 million. So a potential 3x. Now, how long it takes for the company to re-rate to 2.4 billion, if it ever does, remains to be seen. But I also enjoyed Matt Peterson's presentation on Seritage in his 2021 annual meeting. And he came up with about the same property value, 3.9 billion, just shy of 2 billion to equity, according to his numbers. He also put in, estimates of CapEx over the next 3 or 4 years. So this was like a 2025 target for the company. Thinks it'll be worth around $35 per share in 2025. So right now, from 24. That's not right, is it? No, that's the preferred share.
No, yeah, whoopsie.
What
is it?
I think it's at around 15,
Yeah.
15 a share right now. So 15 to 35 in, what is that, 4 years or so? Pretty good rate of return, north of 20%. So that's kind of the quick story for Seritage. Tom, Karan, you have anything to add? Oh, the first thing that got me interested was seeing that Monish Pabrai bought in during, shortly after the pandemic. The stock went from like $40 down to, I think, $5 per share. And Pabrai got in around 6 or 7. There's a big ownership stake from, why do I always forget his name? Eddie Lampert.
Eddie Lampert.
Yep. And Guy Spear is also invested in Seritage. And of course, Warren Buffett through Berkshire owns the debt, and also Warren Buffett in his personal account. We used to be able to see that because he owned more than 5% of the outstanding shares. But because some of these operating partnership units got converted into shares, he dipped below that 5%. So we can't see if Buffett still owns it in his personal account. But yeah, that's kind of a rough overview. Anything I missed, guys?
Dead.
Yeah, I guess. Yeah, I guess the name of the game with this one, it's you've got a portfolio that's not. There's a lot of empty space in the portfolio at the moment in terms of like what's rented out and what's not. So
Yes.
There's a pretty longish runway for kind of redevelopment projects that they have to do, which is going to take some cash. So they're sort of like self-liquidating some of the properties that don't look as attractive for redevelopment to fund that. And I mean, just referencing like on the valuation spreadsheet you did, Brad, with some of the properties they've sold, like your numbers do seem fairly conservative for what's actually turned up when they've sold some of these properties in most examples I've seen.
Like the recent sale.
Like the recent sale. Yeah, and there's some weird stuff in there. Like they had one address. Was it a Hawaii property that was sold recently? I think.
Yeah.
So they had one address for a Hawaii property listed on their website, which Brad went and valued. Turned out that was actually 2 lots, and we were only accounting, or Brad was only accounting for like half the value, if that, or something. So there's this other kind of interesting stuff that just keeps popping up. And I've talked to some other people that have gone quite in depth with like even just land, like extra land area they've got kind of around the big box, what used to be Sears stores, that's just like parking lots and so on. So it's sort of like leaves a bit of room for expansion for more.
A lot of
square footage.
acreage, yeah.
Yeah. But yeah, the big thing hanging over it is the debt payment. I think 1.6 billion at the moment to Berkshire, which is fairly expensive debt. It's like 7% interest, I think.
I think it's 7, yeah.
Yeah, and due in 2023 from
Right.
memory.
Mm-hmm.
It's one of those like it's really a time game with Seritage because of that debt. They gotta really land on their feet with at least a couple of these larger kind of what do they call them, like the prize properties, like the kind of premier ones that will probably drive a lot of the value. They got to really stick the landing on those, and if they do, they should be in a fantastic position. But if they don't, well, they're in a really rough one because all that debt. So yeah, that's where I was getting at with the debt. It's kind of a time game because of that.
One of the best parts about their debt is that it's only held by one counterparty. So normally if you have like a syndicate, they can come after you. But then we've already seen that Berkshire Hathaway is going to support Seritage when times are difficult. Mm-hmm. So
yeah,
I think that adds a hidden sort of margin of safety in a way.
Yeah.
Yeah. And it's a difficult one to analyze. Like if you look at just the financial statements of Seritage, it looks like a dog's breakfast. Like they're burning cash and they've got a bunch of debt, and revenue's been dropping year after year. But yeah, I guess once you understand the details and kind of see some of the redevelopments they have done so far and some of the ones they've got planned, it's pretty impressive. Really... Like you could fairly easily get to the current market cap with a handful of their big developments once they're kind of ready to go, and then they've got all of these other properties that that they're going to do something with or sell.
Mm-hmm.
So
they've got earnings in like 3 days, right? They're releasing earnings on second.
Sounds about right. Yeah.
Yeah.
It's really like it's an asset value play. It's not like a short-term cash flow or you're getting a discount there. It's playing along with the big assets and seeing if those convert.
That was almost a quote from the CEO, Jack. That's
Oh,
what
yeah?
Andrea Olsen said. Yeah. What did she say? Like, if you want cash flow today, we're not your girls. This
That's
is
right.
Oh, yeah.
asset value play,
Yeah.
something like that.
Yeah.
Longer term, it could easily turn into kind of a stable cash flow sort of thing. I think that's what they're going for. Obviously, I don't think they're becoming flippers, but that's it's an interesting one. I've like looked at it a few times, and I'm just like, I've already got enough debt on my own plate of real estate. Don't really need another company doing it too.
I don't
It's
need
like,
to borrow someone else's debt.
yeah,
Right?
yeah. So that's why I have like Equity Commonwealth in my portfolio. I know Karan does as well, which is almost like the opposite. It's like a cash pile with a few properties.
Jack, did you read the recent earnings call transcript from Equity Commonwealth? They're they're considering winding up.
Oh, I didn't realize that.
Yeah.
I know that they had mentioned that before in all the shareholder meetings. They kept being like, "Hey, are you going to give us all the cash?" Basically, because they were when that Monmouth deal was announced some time ago. It received like some pretty negative feedback at like the shareholder meetings. Like, why didn't you just pay us the cash? Like, why are you overpaying for an industrial portfolio? And I can't say I'd be surprised if they did wind up. Granted, that wasn't the goal of going in.
No.
I think in the next 3 years, I think Seritage might be the best performing company in this portfolio. Possible.
Wow.
I think so. If it works out, I think it'll probably outperform the rest.
Well, I'll take that as an
Sure.
endorsement of my pick, Karan.
It has a good ceiling for sure in like the short to medium term, even like maybe not short, definitely medium. Short's going to take a while, especially with all the supply shortages. How has that affected things over at Seritage? Supply shortages and like construction delays. Have they mentioned that at all?
I don't know if we get a huge amount of clarity on that, to be honest. And
I'd wonder.
It's probably only in the last 1 or 2 quarters. So it'd be interesting to see if they say much about it in the next few days. But it's really only in the last couple of quarters. I think it's been we've seen crazy lumber prices and all sorts of things. Yeah, I mean, the good thing about Seritage is although they're paying for these developments with cash and debt, they're also in a way paying with it by like liquidating properties. So if we do see a bunch of inflation or something, like they're not going to lose a lot of purchasing power to do those redevelopments because you've got like hard real estate assets that you're selling to kind of fund those things. So I think that does help Seritage in a way, but obviously commodity prices can run a lot faster in the short term than commercial real estate prices. But you know, over a longer period of time, that should help them, I think. But it's a good question. Like I don't have a good answer for it really.
It's a high upside, some significant risk, but it seems like as time goes on, as they get closer to completion of those projects, the risk would diminish. But at the same time, the cash burn isn't stopping. So, did you know how many like months or years they have left? It's more than months. How many like years of cash burn do they have left before things become a big problem if they don't like liquidate a lot of things?
Well, yeah. What did you just say the portfolio's worth, Brad?
What, 4 billion liquidation value?
Yeah.
I think that was Frank's big concern when he was selling out, right? The cash burn. Remember?
Yeah, the cash burn, when I last looked at it, was about $2.20 per year, per share per year.
Yeah. I mean, you can't really just look at the cash flow statement and say, you know, they lost this much cash this quarter, and therefore they can do it for this long because they're funding it by selling properties. And
I get it's
a bit
deeper
of
than that.
kind of estimate work, kind of in figuring out how much of that.
I like Roman Steve's comment there. Can you highlight that one, Jack? not very bullish, it seems.
Not bad. I can tell he doesn't like retail.
Oh, that's good. That's good.
Now, that's kind of what it is right now. because like until the properties are completed, you just have an incomplete property, and that's not going to get you very far. You got to complete the deal, and then you'll be much better. Yeah, well said. Well said in a very negative light.
Yeah, I mean they have some properties that are pretty terrible, honestly, and they have some that are like insane, like class A real estate.
Yeah.
That's going to be like ridiculously valuable. So
Yeah.
that's not a weed, but there's some in there. We got the whole garden. There's some nice stuff
There
in
you
there,
go.
and there's
Yeah.
some weeds.
It's a very
And we're
large.
trying to
it's a
get rid of
it's
the
a
weeds.
parking lot. Is sticking with the Sears theme. It's a huge parking lot,
Ooh.
and it's all cracked and terrible, and like 90% of it. But then in the middle, there's just like a little oasis that once you get through the mile of parking lot, there it is.
Yeah, but Jack, it's free.
It's free.
Yeah. It's a cigar bar. Like you don't have to pay for the parking lot.
Except
So what's the matter?
Except the cigars is on fire and it's burning quickly because
So just
come on.
just to keep on track here, Jack, we got to hear your idea.
sure.
We're running low on time.
If you want to hear my idea, the
Oh,
secret symbol
Oh, boy.
is here.
Wow.
That's right. We got Turtle Beach. I mean, is it a
Oh,
bad
man.
idea to have a NASDAQ stock in a value portfolio? Like, my goodness. But Turtle Beach is a stock that's been in my portfolio for a good amount of time now. And it's I actually first heard about it when Brad was doing his Magic Formula update back in the fall of 2020, I think. That's when I first heard about it because it's come on and off the Magic Formula screen a few times because they have a very high return on invested capital over the past 5 years or so, including this last couple of years. So that'll automatically put you in the running for Magic Formula, and they're throwing off a good amount of cash flow. But let me pull up some metrics while I'm at it. It is a bit pricier than I would prefer if I was going to dump a huge amount of money in it, which is what we're doing with this mock portfolio. But oh well, up 1% today, and poor timing. But oh well, what are you going to do? It's kind of been bouncing around the like mid 20s up to around 30 to low 30s for the past few months. I initially bought in back in December around $20. So I guess I sort of timed it decently, all things considered. But I've been adding a bit here and there along. Once it gets near like the mid 20s is usually when I'm adding, because I still think it's decent value. Because if we go over to their ratios, well, here's some revenue, or here's their return on capital over the last 5 years. I think they're averaging about 20% return on capital, which is really good. And they're in acquisition mode right now, trying to buy other brands. I guess I should explain what Turtle Beach is at a high level. It's a gaming headphone company. If we pull over their website, that's like their main sort of bread and butter is console headsets, but they're diversifying into PC accessories like this mustache dude or something.
Stop to disrespect the man.
Frank, you got to send him a picture of you, and maybe you'll make the front page here.
And then they've been making acquisitions as well. Like I was mentioning, they bought Rocat back in 2019, which is kind of their PC like accessories branch that they're trying to build out. That's probably one of their bigger catalysts for growth is PC accessories, since they kind of have like the majority share of the console headset market. That's been their backbone for a while. So they bought this back in 2019, and it continues to do well. I know I see a lot about them like winning awards for like best piece of PC equipment or whatever that's worth. And they're doing pretty aggressive sponsorships with like gaming streamers and stuff to try and build up that brand recognition. And then recently in 2021, they also bought Neat Microphones, which tangentially related to gaming, but also I guess a decent amount of play in like the music and streaming industries in general. But that's generally the theme they're going with. They're throwing off good cash flow. They're using that cash flow to invest in other businesses. And best of all, they have basically no debt. Right now, they're worth like $450 million in market cap, with about 50 or 60 million in cash and only 5 million in debt. And it's one of those companies that I'm not worried about like folding or there's not a lot of cash burn or something like that. Even if they did really poorly, I wouldn't expect them to go under anytime soon. So that's something that's important to me is capital preservation and not and making sure that my downside is protected in some way. In this case, they have basically no debt, good amount of cash flow, so they should be able to weather some storms for a while if it came down to it. I guess the big sort of bear factor here is that they had a very, very strong 2020 into 2021 with the release of a couple of new consoles. They got to ride the coattails of that. Plus, you had the extra catalyst of everyone being at home and lots of people buying gaming equipment and all that stuff. So you had a new wave of video gamers who wanted equipment and whatnot, and they directly benefited from that, which is great. But I wouldn't expect that same sort of revenue growth that they've seen in the last year or two to continue at that clip. That's kind of your bigger risk factor, but that's what I got on Turtle Beach.
Is this a long-term hold for you, Jack? And if so,
Yeah.
what do you see as the kind of long-term competitive advantage of Turtle Beach?
Well, I think this focus. Well, they kind of have. I don't want to say they have the console headphone market cornered because it's not that simple, but that's kind of their backbone that they're kind of springboarding off. I think they've proven themselves to be good capital allocators based on that nice return on invested capital, the metrics that they've kept with over the last few years. And if they keep making good acquisitions like this, building out their share of the PC market as the gaming market in general grows, which I expect it to, that's kind of a bigger portion of this. It continues to grow worldwide. As long as they have a decent share of that market, their slice of the pie should grow too as the whole pie grows. So even if they weren't to take a massive share of the market itself is growing too. So I think that's a good tailwind for them. At least that's my perspective. You might be less bullish on gaming in general, but it seems like the direction is positive overall for gaming. So it would be a longer term hold for me, and that's why I keep adding to it.
So I actually looked at Turtle Beach I just checked when I put the video up, September last year. So it was about $10 per share. So in hindsight, that was a missed opportunity right there. But just the reason
really hard in March 2020, like extremely hard. And it took a while to recover.
Down to 5 or something.
Yeah.
The reasons I ended up passing on it was mostly because of cyclicality, just with the console cycles going through that kind of...
You cut out on me, Frank. What'd you say? Mostly because of the what?
Cyclicality of the business, just because they kind of, if they're sticking to just headphones, which they are diversifying away from a little bit, it kind of coincides with the console cycle. So as new consoles come out, maybe people start to buy more headsets, which is why I was kind of interested, as they possibly at the time were at the bottom of the cycle. Now with the new consoles being out, they're probably towards the peak. They have had offers to be bought out for around $35 per share. Is that
36?
Right,
yeah.
There you go.
They actually turned down an offer to be, whether it was a legitimate offer or not was kind of up for debate. But they turned down an offer for $36.50 per share. At the time, I think they were trading at like 27-ish a share. So a pretty big rejection, I would say. But go on.
And then the other thing that come across was that insiders owned very little from memory, maybe like 5% off the top of my head, or possibly even less. And during the research, I was kind of doing some comparisons with other companies, and I come across Razer, which is kind of, you could say Turtle Beach have the North American market pretty well established, and Razer's more of the Southeast Asian market. And I just happen to like that company more, and that's sat on my watch list for a very long time. So I kind of just lost interest in Turtle Beach for that reason. But of course, in hindsight, that was a bad thing. And I guess it's still a bit of that special situation kind of there where they're getting offers for higher than what the share price is worth. So there's that extra margin of safety, I guess, that management definitely believe it's worth more than that since they're not selling the company. And there's companies willing to pay that as well. So that's an added bonus.
I see someone asked, I've definitely agree on the cyclicality. That is a big, it follows the console cycle, like with, I know you've done your content on Nintendo as well, has kind of a good bit of that too. And that's something to be aware of course. However, because they're taking the direction of trying to move away from that more into PC accessories, that's a big focus they're going for. That should serve them well in avoiding some of that cyclicality over the long term. As long as all goes well, of course, which is always a caveat. Someone asked me what percentage of my portfolio it is. It's approaching like, what am I at? I can tell you right now. It is at Let's pull up the chart. About 10%. There we are.
Total 31 positions, right?
Yeah, I'm down to 31 now, and it will be a 30 on on once I close out on probably Monday or Tuesday. So there it is, Turtle Beach 10%, Equity Commonwealth at 15. We'll see if that remains much longer if they don't wind up, and then Pershing Square is my largest. So yeah, and this is probably going to continue to grow as I add a bit more to it, unless it goes on a crazy run up. But I guess in that case, it'd be growing anyways. Are we down to Frank?
Yeah, he messaged and said he had to go.
He's on daddy duty, so what are you going to do?
I like
The
this
kiddo
question
woke
from,
up. Yeah, what's that?
This question from Ba Hucha. Punchcard team, how many of you would buy the other members' high conviction stocks? So us buying into each other's picks. I think
Right.
Alibaba is the only common holding.
I think so. Yeah, right.
For all of us.
Yeah.
I'm getting roasted by After Dinner Investor on my chart.
You are. Yeah.
You should have seen it like a couple months ago, man. It was a lot worse. just look at cover up like this third here. Just ignore this third and look at these 2/3, and then it's like, okay, it's
Not terrible. It's not terrible.
It's mostly just ETFs.
It's like 7 positions.
Yeah, it's ETFs that I've been winding those up and then moving them into other things.
Yeah, on that question about buying the other ideas, I think we all own Alibaba, right? All 5 of us.
Yeah.
I'm pretty sure, and various sizes. I own Seritage, and I think Karan still owns Seritage, so that's kind of that covered.
That's Brad.
I
think.
Yeah.
Mm-hmm.
And what else? Turtle Beach I haven't looked at. KPG I've looked.
3 of us own it.
Yeah.
So Brad, Frank, and myself.
I think KPG is just Frank, right?
Yeah.
Yeah.
Yeah,
And
I've looked at that very closely.
You own KPG too.
No, I own Turtle Beach
In the Magic Formula portfolio.
in the Magic Formula portfolio. I'm like, why didn't you pick it up earlier, Magic Formula? I bought it like $22. Why wasn't it beeping at me at 5, right? Anyway, yep, those are the 5. Eric highlighted the 5 in the portfolio right now.
Mm-hmm.
No crypto. Karan.
Should we throw up the old portfolio pie chart on shares?
Oh yeah. Drum roll.
I have it up, Tom. You want to show it?
Oh, just as my internet explodes. Hang
All right,
on.
I'll give you a moment.
Why don't we take this question here, the most recent one from Roman Stees. Warren's net worth is 50x. Charlie's feels wrong. Should be 10x max. You know what? Charlie doesn't care. Okay, that's my take.
Charlie won the game.
Is it a competition?
Net worth is like 10x, like 100x Einstein. So, what do you want about?
Right. Comparison is a brutal game to play. Charlie, I don't think does it.
When did Charlie start? That's probably a couple of years difference in when they started or something.
Probably, yeah. Like a decade or more.
Yeah, give it 10 years.
Yeah, Charlie went down the Jack Duffley path and became a lawyer first, and then became an investor.
How are you supposed to invest without some salary, you know?
Yeah.
Charlie was into real estate too, so
yeah, he was in real estate too. Borrowed a crap ton of money, and then met Warren.
Yeah, and then now is enjoying the fruits of his labor.
Yeah, I think I've heard Toby Carlisle say this, but I'm keen to get if anyone's got like a job position going in like a Charlie Munger type role, send that my way. I'd be happy to apply. I'm looking for a Charlie type position at Berkshire.
Yeah.
Just go on the boat all day.
And you put your resume in. I have 30,000 subscribers on YouTube, and I pick stocks.
and I have nothing to add.
They're like, you got it. You're in.
Just have nothing to add. Yeah. All right. I think I'm good. If we wanna share the screen.
Okay.
Oh, fantastic. Here's the portfolio.
Right. Okay. So this is ShareSite. Shameless plug. The Punch Card Investing crew are ShareSite affiliates now. I don't know, Jack. Are you going to leave that link pinned comment?
It is in the
or-
description.
Okay, great.
Punch. It's what is it? Sharesite.com/punchcardinvesting.
That's the one. Yes. Yeah. So I've personally been using Punchcard. Been using ShareSite for a couple of years now. So this is a little bit different because it's a hypothetical portfolio. But for me personally, it integrates with the two different brokers that I use. So anytime I make a change to the portfolio, it just turns up in ShareSite. And I'm earning all my money in New Zealand dollars, so it allows me to track currency fluctuations on my US holdings. And gives me some like tax reports and stuff that I can just ship off to my accountant, and it makes tax time like way easier than it would be otherwise. But one of the cool things it'll do for this exercise is we can track the performance of the portfolio against some sort of index of our choice. So I've just chosen SPY, S&P 500 ETF. So we've got currently like 1 day worth of tracking here. So don't read into this performance too much just yet. And if I scroll down, these are our 5 holdings. So we were messaging this morning, and we had to make a call between doing round numbers of shares or doing really obscure fractions to get exactly a 20% weighting. So we went for the real ugly numbers and an exact 20% weighting. So that's 5 holdings. Got a bunch of reports. I'll just go to the diversity report because that'll give us a nice pie chart as our starting portfolio.
Beautiful.
And exactly 20% in each. So we will see how that one develops over time.
This is the final form of Jack's portfolio. This is what it'll look like.
Oh yeah.
When we're making our way.
Jack's portfolio will start out like this once he's cleaned it up a bit. And then in a couple of years' time, Turtle Beach will have just consumed 90% of the pie.
Yes,
crushed
absolutely.
all the other holdings. Yeah.
Except if you add real estate, my real estate holdings, that would dwarf like everything if you just looked at like asset value without subtracting the debt. It's like I'm very heavily weighted. All the risk for me is in real estate, pretty much.
And it's true, Jeremy. Tom did die inside when he couldn't buy a round number of shares for each of these positions.
Yeah, you were squirming
really
a bit.
hurt.
You were squirming.
Yeah, I mean, I was in here like adding Prosus for Quran, and I gave Quran like an extra $200 or something just to make the shares round, and that was great for me. I didn't mind that at all.
I was gonna say like in 5 years' time,
200,000.
I was saying in 5 years' time, it's gonna come down to like the $1 that was allocated to one other person, and that wasn't, and like that's gonna be the difference on the best return.
Yeah. This will also be quite useful because we have got one. I've set this up as like a US dollar portfolio, so it's treating Cali Partners, I guess, as like an international holding. So we can track currency exchange and all that sort of stuff on that, and we can also look at performance against the index over whatever time frame we want. So should be pretty useful.
We got some questions on why it's equally weighted. If you missed the beginning, this is our sort of fun games portfolio, but it's serious, good competition on trying to just see like how these holdings do. These are our best ideas. And we wanted to start with equal weighting so that each one of us gets one pick, and no one pick is, outweighing the other at the start. And then if we decide that we want to add a new holding to this portfolio, we have to subtract one first, and you guys will get to vote on subtracting which one actually gets taken out. So that's going to be the drama when we decide, hey, maybe we're going to talk about Facebook in a week or two. And if the majority of us decide, 3 of the 5 of us decide we want to add Facebook to the portfolio, then we're going to put it out to, add Meta to the portfolio. Then we're going to put it out to a vote for you guys to decide which one gets removed to make room for it. So that'll be the fun part of this. When we put it out for a vote, we'll see. We'll definitely keep you guys posted on when we want to do that. If you like this idea, let us know in the comments below, because comments help the algorithm too. So that would be great. And let us know if you got any ideas out there for what might get added, maybe sooner rather than later. And that's all I got there.
We're gonna have to have some sound effects when people are getting voted off and stuff. Like that's gonna be intense, Survivor style.
I was thinking like the Who Wants to Be a Millionaire, like dramatic music, like dun dun dun.
Guys, what's going to be the bet that we fast forward a year and the portfolio's got the same 5 positions?
Oh no,
We-
definitely not.
I think it will. I think it might.
Oh wow.
I
I think
reckon
at least
there's
3 out of 5 will be the same. But
Yeah, I could see the majority for sure, but 5 out of 5, I don't know.
Look, I think if we stick with the name Punch Card Investing and we take that to heart,
Yes,
think it
but
could-
we're dealing
could
with
do it.
5 people now, 5 opinions. You know,
We
We'll
have
see what
5
happens.
punch cards then, or how does that work?
It
Yeah, we
won't
get
be
100
like
punches now.
yeah, right, exactly. Yeah, that'll be fun. Yeah, we'll see. I would bet that at least one is getting out. It might be mine. Or if anything, 'cause think about it. We have 5 companies. If anything fundamentally changes in the next year with any one of them, that could be like an excuse to get rid of it and add something else that we like better. So I'd imagine at worst or at best that might happen to one company in the next however many years. But we'll
Yeah.
see.
Yeah, I'm really like it's an interesting one because with a position like Alibaba or I mean any of them really, but particularly the Chinese names in here, like I feel like narrative drives price a lot with those
Yeah.
type of stocks.
At least right now, for sure.
Yeah, so I guess we're going to be like the first filter on that and try and stay rational amongst all the noise. And then I feel like you'd think the people watching in the chat here would be much more rational than your typical stock market
I
investor.
think so.
I'm
I have
hoping they
faith.
can see straight through the noise. And
I have faith in our people, especially seeing the Discord and how
Yeah.
level-headed people are. So that I do have faith that people will not be unreasonable. But you can never count on 100%. So we'll see. We'll see what happens.
That's why we've got 2 layers, though. We've got us, and
Right.
then we've got the subscribers.
Yeah,
If it gets through all the filters, it probably doesn't deserve to be in the portfolio.
yeah. That I guess that's true. I guess.
we should really
Yeah.
compare this portfolio to the April Fool's portfolio. Like, see who.
Oh gosh.
Oh no.
Tom and I picked like home run portfolios with thinking that we were just picking jokes. I did Hertz call options like the week that expired, like the week that they got their bankruptcy bailout announcement. So like I would have been up like humongous. It was like 3-week expiration on like this super illiquid option market.
That's
for Hertz.
ridiculous.
That's what I was saying I would do. Tom did did you do Doge or Bitcoin?
Jeez. I
You don't even
think it
know.
was Doge.
You
I
did-
think it was Doge. Yeah.
Wasn't it Sears, Hertz? What
No, it
was that
it was
telecom company?
Doge, Sky TV,
Yeah.
GameStop, Nikola, and one other.
Is Nikola still around, or have they been discovered as a
I thought they
fraud?
rolled
No.
off the cliff somewhere.
I think they're they're in motion towards the ground.
Yeah, they are.
And what's his face? The CEO, Trevor Milton, is in a lawsuit right now for fraud, and it looks
Oh,
like he's in
God.
big trouble, as he should be, based on what we know. So, yeah.
That's a slippery slope, though. No.
Of course, Hertz was the fifth one. We were just talking about that.
What was the 5th one? Sorry.
Hertz. We were just talking about
Hertz.
it.
Yeah.
Would have done well.
Solid names. Yeah.
It actually would have done well. It's amazing.
Yeah, the world's a strange place.
It is. The question is, the thing with those kind of stocks, let me know what you guys think about this, with kind of like these big momentum type stocks that just make like no fundamental sense, but people buy into them anyways, thinking like, yeah, I'm, going to be rich or whatever. Like, who actually holds like a 10,000% return? Like, you have to be the kind of person who would like actually hold all the way through and then sell, but those people don't sell. They just keep holding and want more and more and more, like at a certain point, it makes zero fundamental sense, but you're never going to sell because you didn't go in with any sort of plan. You guys think the same way about that sort of thing?
Yeah, I love the claims put out. I think it's like Motley Fool does this all the time. It's like, if you would have bought Amazon in 2000, you'd have this much today. And it's like,
you'd have to hold it.
Yeah, who's going to do that?
You'd
Who's
have
going
to
to hold
hold
it for 2 decades, right? That's the hard part. So yeah, it drives me nuts.
You'd have to have, like, you'd have to be like, I dare I say, unreasonable enough to invest in this super speculative thing and then still hold it the entire way through, which is just like so hard to do when you're starting with like something really small that doesn't have a lot of fundamental sense to it. And not even talking about Amazon, but just in general, kind of like some micro tech stock like out of Wolf of Wall Street, like that makes no sense to hold, but because all your friends are buying it on Wall Street Bets, you're going to hold it. Just nothing makes fundamental sense. So yeah, fun stuff. On that note, should we talk about Tesla right quick from
Boy, wow.
After Dinner
Let's do
Investor?
We love talking about Tesla.
This will be our closing note. Tesla's valuation. Well, I know they have some okay.
It was absurd at like $200 pre-split. It's absurd at $5,000 if you look at it on a pre-split basis.
We should separate the business from the stock for a second, because like they just got some great news as a business. They have the Hertz. Hertz is back in action, and they put in an order for like 100,000 cars or whatever. That's great. If you're running a car company, you want people to buy cars. But does that mean it's worth $1,000 per share right now? Like, it's $1 trillion company, bigger than like every other automaker combined. Just, yeah, I can't get behind that.
Yeah, I with some of those comparisons, like I can see what people are trying to do, comparing market caps of all automakers to Tesla, and like it's a ridiculous comparison. But a lot of automakers, like Ford is a classic example. I don't know if you've still got ticker open somewhere there, Jack, but Ford has like crazy amounts of debt. Like if you did that comparison on enterprise value, that'd be quite interesting as well. I guess it'd look even crazier actually, wouldn't it, if it was on an enterprise value basis.
I'm not saying that they're the same, of course. Like I think Tesla in general is a very like good, strong company, but there are lots of good, strong companies with bad stocks.
Yeah, I mean,
not that you couldn't make money in some period of time, but if you're looking for long term, it's not something that I'm personally going for sure.
Yeah, I mean, I've had investments in the auto space before. I was in Fiat Chrysler, and I guess that's quite a different beast to Tesla. But having been an owner of that business for a while, I can, like, stock market valuations and stuff aside, I can see a lot of the advantages that Tesla have. Like some of the numbers they're cranking out with like efficiency gains over the last couple of quarters. I think they dropped off like, I want to say it was like $1,000 or $2,000 per unit. They dropped their cost of production in the last quarter, which is just like crazy efficiency gains. And they're also, the way they've structured the business is like one of the terrible things about a traditional automaker is, I don't know, just take Ford, for example, or Fiat Chrysler is a good example because I've got so many brands under the hood, and they've got a bunch of brands which all have a bunch of models which all get refreshed every year, and all of a sudden you're spending so much money on retooling factories and stuff. And here you have Tesla, which basically just has like, what is it, like 4 models or something at the moment. They've basically not updated them in close to 10 years for the Model S, I think.
They've updated them now.
Yeah, but it's minor stuff. It's not like they've got a whole new, well, they might do, but I don't think they've completely changed like the shape of the body or chassis or anything like that. Like it's mostly cosmetic stuff as I understand it. So yeah, they're becoming like a really efficient kind of low cost producer of cars.
Again,
and they've got a massive head start.
Strong business. Like
it didn't used to be a strong business. Like when it got down to what, $200 or $300 a share or something pre-split, when everyone was super negative about it, and like Jeremy and all that was starting to buy in. Like they were at real risk of bankruptcy back then. But now, since the stock has gone up so much, which is like, I hear people often talk about, like buy into companies you like, and that's a way to support them, which I don't always buy into that because, someone already owns the shares. It's not like the company's getting money.
Just buy the product.
Yeah. But in this situation, so many people have bought the stock and it's gone up so much that they've been able to raise money like without, I mean, they've diluted a fair bit.
It's a bailout almost. Like,
yeah, I mean, the stock's gone up so much, they've been able to raise enough money to probably go on forever. And I think they'll do quite well, like the underlying business. But again, the investment as a whole, another question.
Yeah, right. That's right. You got to separate the two, which a lot of people don't do. Like you're saying, they just buy into whatever. Oh, I like the company, therefore I like the stock. Well, that doesn't work. It's not that simple, unfortunately. If it was that simple, that'd be fun. But
Elon got enough companies going on right now to like start his own ETF at this point.
He actually does.
SpaceX, Tesla, Boring, Neuralink, is it?
You could almost count Solar City as its own
Solar
thing too.
City is part of Tesla.
Yeah, but it's kind of its own thing, Yeah, anyways. Good stuff. I hope that answers your question, Jason. By the way, go check out After Dinner Investors' YouTube channel. He's up and running now on YouTube, and he's got some good stuff. He had a recent feature on the Brad bar. I liked that one.
That was great.
I won't spoil what that is if anyone wants to go check that out. But Jason talks a good bit about our very own Brad Kellner, and a good idea.
He may be Brad's biggest fan.
Oh yeah, he's got to be. But it's within reason. It's within reason. So
we should have a head-to-head portfolio with ADI versus punch card.
That would be kind of fun, actually.
The
cloner portfolio versus the whatever you want to call this, where people vote stocks off. The survivor portfolio.
Exactly.
Alrighty, shall we wrap it up, folks?
Let's wrap.
Frank already wrapped up. He's dealing with the baby. So thanks everyone for stopping by and listening to our best ideas. Whether or not you like them, well, that's all we got. That's our best ideas, folks. Always cycling through new ideas all the time, and we appreciate your input on not only vetting ideas but discussing them, like over in the Discord. Check that out in the description if you haven't already. Lots of good stuff in the value investing world. I think we got to talk about Facebook/Meta next week. So stay tuned for that. Either way, we'll have a new episode every single week around this time. And be sure to subscribe so you don't miss that. Hit the bell icon so you don't miss notifications when we do go live. If you happen to be awake at wherever you are in the world when you watch these. But yeah, that's enough talking out of me. Till next time, everyone. See you later.